Let me ask you something that might catch you off guard. When you think about the most successful traders in the world, the people who have made fortunes in financial markets, what do you imagine they have that most people don't? Better technology? Insider information? Some secret mathematical formula that the rest of us haven't discovered? The answer, almost universally, is none of those things. What separates the people who consistently profit from markets over years and decades from the overwhelming majority who don't is something far more fundamental. It's the ability to manage themselves. Their decisions, their emotions, their responses to uncertainty and loss. It's discipline applied so consistently that it becomes second nature. And it's a relationship with risk that most people never develop, because developing it requires something deeply uncomfortable, a willingness to be wrong, repeatedly, without losing either your money or your mind. This audiobook is about that journey. Not the journey of learning to read charts, although we'll touch on that. Not the journey of finding the perfect system, although that matters too. But the deeper journey of becoming the kind of person who can actually execute well under pressure, over time, in an environment specifically designed to exploit your worst instincts. Because here's what nobody tells beginners about trading. The market is not your adversary in the way most people think. Your adversary is yourself. Your fear when a position moves against you. Your greed when it's moving in your favor and you want just a little more. Your impatience when nothing seems to be setting up and you start looking for trades that aren't really there. Your ego, when you've had a good run and start believing you've cracked the code. These are the forces that destroy trading accounts. Not bad luck. Not the system. You. And the beautiful, demanding, relentlessly honest thing about markets is that they will show you exactly who you are. Every weakness you have will eventually be exposed and priced. Which means that becoming a genuinely good trader requires becoming a genuinely self-aware person. That's harder than learning to read a chart. But it's the actual work. Let's begin with what the market actually is, because most people hold a fundamentally distorted picture of it. Markets are simply the collective expression of human psychology at scale. Every price that exists at any given moment represents the net result of every buyer and seller making decisions based on their individual beliefs, hopes, fears, information, and constraints. When prices rise, it generally reflects that buyers have more conviction, more urgency, or more resources than sellers at that moment. When prices fall, the opposite is true. When prices move sideways in a tight range, it reflects a genuine standoff. Neither side has enough conviction to break through the other's resistance. Understanding this reframes everything. If markets are made of human psychology, then learning to read markets is, at some level, learning to read human psychology in aggregate. And that means the patterns that appear on charts are not random noise. They are the visual record of collective human behavior, which, because human beings are remarkably consistent in how they respond to uncertainty, greed, and fear, tends to repeat in recognizable ways. This is why technical analysis has any validity at all. Not because charts have some mystical predictive power, but because the patterns on charts reflect behavioral tendencies that recur because the humans producing them keep responding to similar stimuli in similar ways. Now, here's a practical concept worth building into your thinking from the beginning. Markets move in phases, and the phase a market is in dramatically affects which strategies are likely to work. There are periods of expansion, when prices are trending clearly in one direction with healthy momentum, and periods of contraction, when prices compress into a narrow range, energy accumulating like a coiled spring. And then there are the explosive moves that often follow those compressions, as whoever was trapped on the wrong side of the range gets forced out and momentum builds. Learning to recognize which phase you're in is one of the most valuable skills you can develop, because it determines whether you should be aggressive or patient, whether you should be trading breakouts or fading extremes, whether the risk-reward of any given setup is favorable or not. A simple way to think about this: when prices are contracting, when the daily ranges are getting smaller, when volatility is declining, something is gathering beneath the surface. The market is loading. Experienced traders watch these periods with intense attention, not because they know which direction the move will be, but because they know a move is coming. And when it comes, it tends to move fast and far, rewarding those who were positioned early and punishing those who were still waiting for confirmation when the opportunity was already mostly gone. Patience during these loading periods is genuinely difficult. The human mind is wired for action. Sitting and watching, doing nothing while the market drifts in a range, feels like you're missing something, falling behind, wasting time. But the willingness to wait for high-probability setups rather than manufacturing trades out of impatience is one of the clearest differentiators between traders who last and traders who don't. Let's talk about something that may be the most important concept in this entire conversation, and it's one that every new trader hears but very few genuinely internalize until they've experienced the alternative the hard way. Risk management is not a defensive measure. It is the foundation on which everything else is built. Here's why. In trading, you will be wrong. Regularly. Not because you're bad at this, but because the market is fundamentally uncertain and no system, no matter how refined, is right all the time. The best traders in the world operate with win rates that, in many cases, are not dramatically higher than 50%. What makes them profitable is not that they win more often. It's that when they win meaningfully, and when they lose a controlled amount. This asymmetry, larger wins, smaller losses, is the engine of sustainable profitability. And it is only achievable if you define your risk before you enter any trade, and you honor that definition without exception. The rule that experienced traders have internalized, often after painful lessons, is this: no single trade should put more than a small percentage of your total capital at risk. The specific number varies by approach and temperament, but the principle is absolute. When you risk too much on any single trade, you give that trade the power to seriously damage your account, your confidence, and your ability to continue. When you risk an amount you could lose without it affecting your judgment, you give yourself the ability to remain clear-headed, to execute properly, and to stay in the game long enough for the edge to express itself. This is harder than it sounds, because there will be trades that feel like certainties. Setups that look so obvious, so clearly supported by multiple factors aligning, that the temptation to press your bet is almost overwhelming. The market knows this. It has been generating these obvious-looking setups and then doing something completely different for as long as markets have existed. The feeling of certainty is not correlated with the probability of success. Position size should never be determined by how confident you feel. Now let's talk about something that will happen to every trader eventually, and the way you handle it will go a long way toward determining whether you have a future in this. The losing streak. It doesn't matter how good your system is, how much experience you have, or how carefully you've managed your risk, there will be periods where trade after trade fails to work. The market shifts into conditions your approach doesn't suit. A run of bad luck coincides with some suboptimal decisions. Whatever the cause, the results are the same: a series of losses that accumulates into a meaningful drawdown of your account and your confidence. This is where the most dangerous impulse in trading takes hold. The urge to get it back. To make a larger trade, to take a less well-defined setup, to abandon the rules that normally govern your decisions in a desperate attempt to recover what you've lost. This is called revenge trading, and it is the mechanism by which small, manageable drawdowns become catastrophic account destruction. The logic of revenge trading is emotionally compelling and mathematically bankrupt. The market owes you nothing. It has no memory of your previous losses. The next trade has exactly the same probability distribution as any other trade in similar conditions, regardless of what came before it. Increasing your size or lowering your standards does not make recovery more likely. It makes catastrophe more likely. The correct response to a losing streak is almost exactly the opposite of what your emotions are demanding. Step back. Review your recent trades honestly, not to beat yourself up, but to determine whether your losses reflect the natural variance of a sound system or whether there are genuine mistakes being made. Reduce your size if necessary to take the emotional pressure off. Wait for a setup that fully meets your criteria before re-engaging. Protect what you have left. The money you preserve during a drawdown is the fuel for your eventual recovery. This discipline, the ability to accept losses and not compound them, is, in the view of most experienced traders, more important than any edge you might have in your system. A mediocre system executed with excellent risk management will outperform a brilliant system executed emotionally over any meaningful period of time. Let's discuss the structure of a trade, because many people focus obsessively on entries and pay insufficient attention to the elements that actually determine outcomes: how you manage the trade once you're in it, and how you exit. Every trade should begin with a clear rationale. Not a hope or a hunch, but a specific reason grounded in what you're observing in the market. A pattern is formed that historically resolves in a particular direction. Multiple timeframes are aligning to point the same way, creating a confluence that improves the probability of the move continuing. A period of compression is resolving with a directional break in volume that confirms conviction. Whatever your rationale, it should be specific enough that you can state it in a single clear sentence. If you can't explain why you're taking a trade in simple, concrete terms, you probably shouldn't be taking it. Equally important, and this is where many traders are weakest, is the exit plan. Before you enter, you should know exactly where your stop loss is. Not approximately. Exactly. The stop loss is the level at which the market will have told you that your thesis was wrong, and it should be placed at a point that is technically meaningful, not simply at a distance you're comfortable losing. You should also have a clear idea of where you intend to take profits. This doesn't mean you must exit mechanically at a predetermined target. There are approaches where you let profitable trades run and manage them dynamically. But you need some framework for how you'll capture the gain you're pursuing. Without one, the exit decision gets made under pressure, in real time, with your emotions fully engaged, and that is almost never the best condition for good decision-making. Here is something worth sitting with for a moment. Think about how you have made important decisions in other areas of your life. Perhaps you've made a significant purchase, or accepted a job offer, or ended a relationship. How did those decisions feel when they were made in the heat of emotion versus when they were made after careful reflection? In almost every domain of life, decisions made calmly, with clear thinking and sufficient information, outperform decisions made reactively. Trading is no different. In fact, trading may be the domain where this truth is most unforgiving, because the feedback is immediate and the consequences are financial. Every time you deviate from your plan because of how you're feeling in the moment, the market eventually teaches you the cost of that deviation. The lessons are expensive. It is far better to learn them conceptually first and spare yourself the tuition. Let's spend some time on something that doesn't get discussed enough in trading education: the importance of maintaining an honest, ongoing record of your performance. Most people who are drawn to trading are drawn by the potential for significant gains. They spend enormous time studying setups, learning indicators, watching markets. Very few of them spend equivalent time in rigorous, honest review of their own trading history. This is a significant error. Your trading journal is not a record of your wins to feel good about or your losses to feel bad about. It is data. It is the evidence base from which you understand your actual edge, or lack of edge, in various market conditions and various types of setups. It is the means by which you can distinguish between a strategy that isn't working and a strategy that is working but that you're not executing correctly. After every trade, record not just the financial result but the reasoning. What did you see that led you to take this trade? Did the trade set up the way you expected? If you exited before your original plan called for, what caused you to do that? If you held longer than you should have, what were you feeling that led to that? Were you following your rules, or were you improvising? Over weeks and months, patterns will emerge from this record that would be completely invisible otherwise. You'll discover that certain types of setups consistently work for you and others consistently don't. You'll find that you manage trades well in certain market conditions and lose discipline in others. You'll see that your win rate is solid but your average winner is smaller than your average loser, pointing to a profit-taking habit that is cutting your gains short while letting your losses run, one of the most common and correctable errors in trading. The journal won't lie to you. It won't tell you what you want to hear. And that makes it more valuable than almost anything else in your trading education. Now I want to address something that sounds almost too simple to be worth saying, but that the evidence suggests most people never fully accept. Your physical and mental state directly affects the quality of your trading decisions. When you're well rested, your prefrontal cortex, the part of your brain responsible for rational decision-making, impulse control, and long-term thinking, operates at its best. When you're sleep-deprived, even modestly, this function degrades significantly. You become more reactive, more impulsive, more susceptible to emotional decision-making. Exactly the conditions under which bad trades get made. Similarly, when you're under significant life stress, a difficult personal situation, financial pressure outside of trading, a conflict with someone important to you, that emotional load doesn't stay neatly compartmentalized. It bleeds into your trading. Your judgment is compromised in ways that are hard to detect from the inside. You take trades you shouldn't take. You manage positions differently than you would when calm. And the results reflect that. The most experienced traders treat their mental and physical condition as a fundamental input to their daily readiness assessment. If they didn't sleep well, they trade smaller or don't trade at all. If they're emotionally activated by something outside the market, they sit out. This isn't weakness. It's the recognition that trading is a performance activity, and performance activities require the performer to be in optimal condition. Daily practices that support this, regular exercise, sufficient sleep, some form of stress management like meditation or time in nature, aren't peripheral concerns for the lifestyle-minded. They are performance tools for anyone who intends to execute complex decisions under pressure over a long career. Let me ask you something directly. When you look at your recent performance, wherever you are in your trading journey, are your losses coming primarily from the market moving against well-reasoned, well-executed positions? Or are they coming from somewhere else? From positions taken out of boredom, or frustration, or the desire to do something when the right answer was to do nothing? From positions that were too large for your account given the risk of the setup? From exits that were premature because you got scared of a normal drawdown, or exits that were too late because you refused to take the loss when the setup was clearly failing? This kind of honest self-examination is uncomfortable. But it is exactly the kind of examination that separates traders who improve from traders who repeat the same mistakes on a loop and wonder why their results don't change. Here's a concept that trips up a lot of developing traders. The idea that they need to find the right strategy, the perfect system that will work consistently across all market conditions, and then simply execute that system. The reality is considerably more nuanced, and understanding this nuance can save you years of frustration. No strategy works in all market conditions. Trend-following strategies perform brilliantly when markets are trending and terribly when markets are range-bound. Mean reversion strategies work beautifully in choppy, oscillating markets and get destroyed when a real trend emerges. Breakout strategies require the breakouts to follow through rather than reverse, which happens reliably in some market environments and almost never in others. The implication is that part of your job as a trader is to identify what kind of market you're currently in and adapt your approach accordingly. This requires a different kind of skill than simply executing a system mechanically. It requires judgment about context, the ability to read the market's current character and adjust your expectations and methods to match it. This is also why studying the market extensively, looking at historical examples across different regimes, developing a feel for how markets behave at different levels of volatility and at different phases of a trend, this study pays compounding returns. Every hour of genuine observation builds your intuitive understanding of how markets move, what the different environments feel like, and which approaches are likely to work in each. There's something worth saying about the role of complexity in all of this. Many new traders go through a phase of accumulating indicators, adding more and more layers of technical input to their charts, believing that more information will produce better decisions. The reality is generally the opposite. Complex systems with many components are harder to backtest meaningfully, harder to understand when they fail, and harder to execute consistently. The traders with the most durability tend to work with relatively simple frameworks that they understand deeply, rather than complex systems they barely understand at all. Simple means you can explain exactly why you're taking a trade in clear terms. Simple means you know immediately when your setup is present and when it isn't. Simple means you can quickly assess whether a losing trade was the result of a bad system or bad execution. Complexity obscures all of these things. What I want to leave you with, as we come toward the close of this conversation, is something larger than any specific technique or rule. It's a perspective on what this pursuit actually is and what it demands of you. Trading, approached seriously and over time, is one of the most rigorous exercises in self-knowledge available to a person. Because the market will reflect your psychology back to you with complete honesty and no sentimentality. Every bias you carry will eventually cost you. Every emotional pattern that you haven't addressed will eventually show up in your trades. Every area where your discipline is weak will be found and exploited by the market, not with any malice, but with the perfect indifference of a system that has no interest in your well-being. This can sound brutal. But there's another way to look at it. What the market offers, in exchange for this rigorous honesty, is a mirror unlike almost any other. A mirror that shows you exactly where you are, measured against where you need to be, with perfect objectivity. And people who do the work, who look honestly at what that mirror shows them, who take responsibility for what they see, who commit to the slow, patient, unglamorous work of becoming better, those people don't just become better traders. They often become better decision makers, better risk managers, better thinkers in every domain of their lives. The principles that produce trading success, defining risk before acting, following a plan even when it's uncomfortable, taking only high-quality opportunities and declining the rest, learning from every outcome without becoming emotionally attached to any single one, maintaining discipline on ordinary days so that you're ready for extraordinary ones, these are not trading principles. They are principles of sound judgment under uncertainty. And uncertainty is the native condition of essentially all significant human endeavor. So perhaps the best frame for this entire conversation is not that you're learning to trade. Perhaps you're learning to think clearly under pressure. To manage uncertainty without being paralyzed or reckless. To commit to a process and trust it even when the short-term results are discouraging. To distinguish between the things you can control, your preparation, your execution, your risk management, your mindset, and the things you cannot, and to focus exclusively on the former. The market will change. Strategies that work today will work less well as conditions evolve and as other participants adapt. The constant, in this environment, is you. Your discipline, your habits of mind, your willingness to keep learning and adjusting. Develop those things, and whatever the market looks like at any given moment, you'll find a way to meet it. Here's the question worth carrying with you from this conversation. Not what is the best trading system, or what indicator should I be using, or what is the optimal risk percentage. Those questions have answers that are contextual and variable. The question worth carrying is this: what kind of person do I need to become to execute well in this environment, day after day, over years? And what am I doing, consistently, to become that person? The market will be there when you're ready. It's always there. The only question is whether you'll be ready for it.